All right. Okay, so let me start. All right, so today we want to quickly look at profit reconciliation. Using what? Variances. So we want to use the variances to reconcile our profit. We want to reconcile our budgeted profit and then our actual profit. So we want to use the variances that we calculate to reconcile our budgeted profit and then our actual profit. So in short, what we are saying is that when we get our budgeted profit and we add or subtract the variances, depending if there are positive variances, we add. If there are negative variances, we subtract. Once we do that, we will now come to get the actual profit. You see that? And that means that we have reconciled our profit using the variances. So in going about profit reconciliation, we can either use, sorry, okay, in using profit reconciliation, you can either use the marginal approach, or the absorption approach. You see, so when we want to use or do profit reconciliation, we can either use the marginal approach or the absorption approach. But for the sake of the exam, we will learn using the marginal approach. In fact, in exam, it's likely the marginal approach will come. And even if they ask for absorption approach and you go by this approach we are using, maybe you miss some few ticks, but you will get majority of the marks. And so mostly because of time, I go by the marginal approach. So if we are using the marginal approach, then it's all about a format. So you start with the budgeted profits. So we start with the budgeted profit. Then you add or less the sales margin variance. You see, but sometimes the sales margin variance can further be analyzed into us. Sales price variance and sales volume variance. You see that? Okay, so let me do this. So we can have what? The sales price variance, sales volume variance. So assuming we want to go the long way, we will have these two variances. But when you net these two variances, you are going to get what? the sales margin variance. So either straight away you find your sales margin variance and add or subtract depending whether it is an adverse variance or a favorable variance. You see, or you split and have the two variances. But when you net these two, you have an amount. Then you now come to the cost-related variances. So cost variances. So the cost variances, if we are starting with material, so you can have direct material. So you have what? Direct material price variance, direct material usage variance. Then when you add the two, you have what? Direct material cost variance. You see that? So these two, but if you want to net them, then you have the cost variance. You get it? Then direct labor. So that one too, we can have direct labor rate variance, direct labor efficiency variance. Then we can have direct labor cost variance. So all this, or if you want to net add the two, then we get this. See that? All right. So then we can continue with what? Variable production overhead. So that one too, we start with what? Direct, sorry, variable production overhead expenditure variance. Variable production overhead efficiency variance. And then what? The variable production overhead cost variance. So you can also have these two, or you net them like this. You see that? Then we have fixed production overhead. So that one we can have fixed. All right, sorry, a minute. Hello, Chris. Yes, hello, my people. So we have what? Fixed production overhead. We have expenditure. And then we also have fixed production overhead volume variance. Then we have what? Fixed production overhead cost variance. So the same way like this, and then the total can come. So even the volume variance, we can also have the capacity and then the efficiency. Then we transfer to volume, and then you get it. So when you net all this, then you can now have what? Your actual profits. Actual profit. Please, any question up to this point? Any question? Are we okay? Please let me hear from you. Are you okay?
Yes.
All right. Mercy is okay. Uh-huh. All right. Let me continue. So let's go and then pick the first question we solve and variances and use that to try or to look at profit reconciliation. So please, let's go to the first question we solved. The first question we solved. So that was the last question. Jack manufacturing. So for Jack manufacturing, please, I want you to assist with the variances we calculated so that it will help us to do the profit reconciliation. So what was our budgeted profit from that question? In fact, if we want a budgeted profit, we use the standard profit per unit. And the standard profit per unit, standard selling price per unit, 100, standard cost per unit. So let me calculate it down here. Budgeted profit will be equal to standard cost. Standard selling price per unit is 100. Standard cost per unit is what? Is 80. Then we multiply it by what? Budgeted output. What was the budgeted output? 1,000 units. Oh, okay. There are some on this page who were not here when we did that. All right. So then I wouldn't want us to use that as the main thing, or I wouldn't want us to go by that. So let's continue. We will come and solve another question where we will have the figures, then we will do the profit reconciliation. But I just wanted you to know that if you want to do profit reconciliation, this is the format. Just have your budgeted profit, add all or less all your sales related variances, and now come to your cost related variances. Add or subtract, you will finally get your actual profit. So that is the thing to do. So as we move on, we will solve the questions so we can reconcile the profit. Any question? Otherwise, I'll move on. So we look at working backward. Any question? Any question?
No questions, sir.
All right. Okay. Now let me continue. All right. So when it comes to working backward simply is where it's just like change of subject. That is where, for instance, you know that in calculating our variances, we use models or formulas. So for instance, if you want to look for our direct labor efficiency variance. We do that by getting our standard hours, we less our actual hours, then we multiply by what? Standard rate. So assuming an examiner gives us the direct labor efficiency variance, maybe he tells us that the variance is 100 or 1,000 adverse, and the standard hours is 800, and our actual hours is maybe our actual hours is 900. You see that? And they say that as for the standard rate, we don't know. Can you please find the standard rate for us? You see? So in such an instance, we need to use what we call the working backward principle. And here we will be using change of subject principle in mathematics to be able to maneuver our way to get the standard rate. And that is all about working backward. So let me post some questions on the page for you to review. Please, let's give ourselves some 5 minutes. I'll come back so that we can start solving questions on working backward. Is that okay? So let me post
Yeah.
on the
Yes,
page.
sir.
Good. Let me post on the page. Okay. So I'm posting on the page. So please let's give ourselves about some 5 minutes. I'm posting, then you can read through, and then in 5 minutes we come back. All right, thank you.